When it comes to communication, I mean, he is the central banker. Sir, this lady already have stolen my thunder, but still, officially on this platform, in presence of this 750 or 800 people here, and thousands of people who are watching this on web, let me congratulate you for two things. You are ranked A+ governor globally in the Global Finance Central Bank Report Cards 2023. You also bagged the title of Governor of the Year for 2023 by Central Banking in London. So, congratulations, sir. So, if it's a Central Bank's World Cup, India is champion and you are the captain of the team, right? Only thing, it's not 20 over cricket, it's not 50 over cricket, it's not even a 5-day test match. It's a test match which runs for years. So, and which is a test match which had seen COVID, which had seen everything else. So once again, Governor, and incidentally, Governor is very fond of cricket. So that's why I'm giving the cricket analogy. So let's start with something macro. Once again, another congratulation is due because we are a part of the JP Morgan Government Index, the global index which everybody had been waiting for. India's will 10% weightage in the global diversified index in stages from June 2024, 1% added every month. Now RBI, as a central bank, you have been preparing here for quite some time, 2020. First, you removed the foreign ownership in certain bonds. You call it fully accessible route. You have done that. And then, of course, allowing the banks to lend margin requirement for foreign investor, etc., etc. But has it come little faster than you waited because of the Russia's inclusion? Because you need to prepare the ground. We need to have more those particular bonds which the foreign investors are allowed to invest in. We need to have more liquidity. And of course, in this kind of geopolitics, always the interest rate risk and the FDI outflow, it can happen once you are integrated with the global segment. So as a RBI governor, tell us frankly, sir.
Thank you very much, Tamal. And at the outset, let me also thank Business Standard for organizing this event and inviting me to participate in the final session of this 2 days event. I think over the last few years, this particular BFSI event has emerged as an important event in the BFSI calendar of our country. So my congratulations and compliments to the entire Business Standard team for achieving this. Now, coming to your specific question, you see, our effort over the last few years has been to sort of expand the investor base in our securities market, especially the government securities market, to expand the investor base, and also to provide, sort of greater opportunity for participation. We have taken number of steps. You mentioned about the fully accessible route. We have also taken several other measures. You alluded to a few, and there is this also things like, for example, we have permitted the banks, the domestic banks, to offer margin facilities to the FPIs, etc. Now, inclusion of India in the JP Morgan Bond Index is their decision. And the first thing that has to be recognized in this is that it's a kind of a vote of confidence about the Indian economy and about the Indian financial markets. So first point I would like to mention is that it's a vote of confidence on our economy, on our financial markets. And I do understand from where your question is coming. Obviously, when you are included in a bond index, it works two ways. It leads to inflow. I mean, the JP Morgan, they have given an estimate of $25 billion to come over a period of time, and all that is expected. But the other side, on the other side, it's a double-edged weapon. I mean, it's a double-edged sword. That is on one side. The other side, as you know, when there are there are lots of, there are quite a number of passive investors who get, who are mainly sort of influenced by your weightage in the index. So the reverse can also happen. When your weightage goes down, the passive funds will immediately tend to move out, or if there is, some other development globally happening, it can, there can be outflow of funds. And in this regard, I would like to mention that RBI has a track record over the years, and especially in the recent period, of handling large-scale inflows and large-scale outflows. Last year, after the Ukraine war started, we did not see the kind of outflow which was there after the taper tantrum. Sentimentally, in terms of market sentiment, I think the overseas investors had greater confidence on India's ability to, the RBI's ability to service the outflow of currency. There was never a doubt that RBI will not be able to meet the dollar requirement. That was because of the reserves which we had built up. So our track record over the years, and especially in the last few years, when outflows happened last year after the Ukraine war, it was handled in a very seamless manner. And similarly, when inflows had taken place before that, before the Ukraine war, or in the, let us say during 2019, then particularly in 2020 and 2021, when liquidity was easy all over the world, there was large-scale inflows. And we utilized that opportunity to build up our reserves. So we have a track record of handling both sides of the so-called double-edged weapon of the bond inclusion. We can handle large-scale inflows, we can handle large-scale outflows. So that is the track record. And then also, in the case of India, I would like to believe that given the overall macroeconomic stability and the financial sector stability that we have, even the passive investors, the world has changed. The passive investors are also looking at other aspects of an economy, the nuances of an economy, the strength, the strength and the underlying fundamentals of an economy. So therefore, I don't think we will see that kind of volatility, but should something like that happen, I think RBI has the capacity to deal with it and deal with it effectively.
Thank you, Governor. Very, very reassuring, and you are, I don't know, it's not even, it's more than modesty. You said that thank you for your participation. Actually, it's a rare honor and privilege for us. You are gracing the occasion. And this is fourth year in a row. Reserve Bank of India Governor Shaktikanta Das, he finds time to grace the occasion of BFSI Business Standard Summit. Sir, second is also, it's a very talk of the town. Everybody talks about that. And you played a key role, you meaning the Reserve Bank of India, is that internationalization of the rupee. I mean, considering our trade, the size of our economy, the size of our exports and our rating, I mean, how much it's talk and how much is actually reality? What does it mean, sir, internationalization of rupee?
You see, we have, our officers have come out with a paper on internationalization of the rupee, and they have shared some of their thoughts and some of the suggestions. So, and the foremost point to be noted in this context is that internationalization of the rupee, like we have said over the years with regard to capital account convertibility, internationalization of the Indian rupee is not a target. It's a process. And there is a phased road towards, towards greater internationalization of the rupee. So we are not, there is not a particular point of time which we are trying to reach in 1 year, 2 years, 3 years, not like that. It's a process. And that is because the size, the presence, and the impact of the Indian economy in the global, in the global scenario is also expanding. Today, India is, IMF time and again, and particularly they have reiterated it recently in their World Economic Outlook report also, that India is going to be the fastest growing economy, major economy in the current year as well as perhaps in the next year. So the size of Indian economy is growing, and the contribution that Indian growth in India makes to world growth is now in the order of 15%. And recently, I think the Director Asia Pacific of the IMF in a, in a press interaction, perhaps to Business Standard, he said that by 2028, India should be contributing to 18% of world growth. So the size and presence of Indian economy is growing. The size of Indian economy is also growing. It is expected to be the third largest in by 2027.
2030,
By
sir.
20,
Latest time, latest
uh,
2030.
okay, to 2027 I thought, but that's okay. That's a matter of detail.
S&P Global's report
So
says
it is going to be the, it is now the fifth largest. It's expected to be the third largest. So therefore, in this scenario, the presence of the Indian rupee in various international transactions is something which should also happen, or, alongside that. Now, we are looking at it because dependence on one currency for international trade for any economy has its risks. For a moment, I am not, let me stress, we are not pitting the rupee against the dollar. There is no such issue at all. Some section of the media probably thinks, and they write about it. It's not so. It's not a question of rupee versus the dollar. The dollar is the dominant currency and will perhaps remain the dominant currency for international trade for years to come. But what we are looking at is to increase the footprint of the Indian rupee in the international trade, especially with regard to countries with which India has very close and active trade relations. So we have signed the MOU with the United Arab Emirates for rupee denominated, rupee or in the local currency denominated, rupee or dirham, local currency denominated export-import. Sri Lanka has already recognized the Indian rupee as a reserve currency, as a designated currency for their international trade. We have also entered into similar MOU with other countries. The UPI linkage is also being simultaneously being pushed. So therefore, and we have also provided the facility of opening a Vostro account, and whereby the entire import-export will be settled by using the Indian rupee. So basically what we are trying to do is to expand, widen the footprint of the Indian rupee in the context of India's trade with other countries, with whom we have greater trade relations. And it's a process we are moving towards that, and something which we feel should happen as India becomes a bigger and bigger economy.
Thank you, Governor, for the clarity. I'm bringing another controversial subject. In fact, if I remember correctly, in 2021, when we have it's on Wave Business Standard BFSI Summit, we did have a conversation, of course, in your office at Reserve Bank of India, and that was live telecast and webcast, and there probably that was the platform where first time you spoke very frankly about your, I would say, allergy towards cryptocurrency. So I'm bringing to the cryptocurrency part. You sort of said that it's over your dead body. You will not allow crypto. Now you banned it. But we're talking about latest IMF FSB paper, which talks about not banning but regulating. I am aware recently in Delhi, you said that there won't be change in your stance. But sir, my humble question is this: if following the IMF, whatever the direction they are getting, if the other countries says yes, and the Indians started using their money overseas for crypto, I mean, is there any plan for that? You are a staunch believer in banning it in whichever way, and etc. Can you just give us some clarity?
You see, on cryptocurrency, I would like to say, and I would like to say it with all seriousness, that it's a very serious issue. It's a very serious threat to financial stability for all countries, for global financial stability, especially for emerging market economies. And that is something which has been recognized in the IMF FSB synthesis paper also. And incidentally, the IMF FSB synthesis paper also says very clearly that based on country-specific requirements, especially emerging market and developing economies may, depending on country-specific situations, may impose additional restrictions with regard to cryptocurrencies. So the problem, the risks are well recognized by the IMF FSB synthesis paper. It has been very well recognized by the BIS paper on cryptocurrencies. Everybody understands and agrees that there are serious risks. So that risk has to be looked at and managed very, very carefully. Why I am saying it's a very serious issue, and I think time and again when I am saying it, it's not a question of, I have seen, comments coming from certain quarters, especially those who are in crypto business. I mean, I can understand their concern that they are very critical of RBI's stance, and it is quite understandable. I don't hold a grudge against them. I mean, they are entitled to their views. But we have to look at from the overall perspective of the macroeconomic stability, and I am not going into the details of what threat it poses to monetary stability, what threat it poses to currency system, what threat it poses to financial stability issues. We have articulated in the past, and I am not going into it. So, to summarize, let me say that it's a serious financial stability risk. It has to be dealt with properly. The believers of regulation, I have only one question to ask. How will you regulate it? Whom will you regulate it? And regulate what? And before you think of regulating it, let us first understand what is this, what is this cryptocurrency? Is it a product? Is it a financial product? Is it an asset? If it's an asset, what is the underlying? It's not a tangible thing. What is the underlying? What is the definition of cryptocurrency? Till now, I am yet to see a credible definition of what the cryptocurrency is. Second thing is, I am yet to come across any sort of credible explanation of what is the larger purpose that cryptocurrencies serve. The third point which comes to my mind and which is very important, what is it that cryptocurrencies will do for international transactions or domestic transactions, whatever you call it, in the digital mode, which CBDCs cannot do. And the fourth and the final point is the basic question. It's a kind of a new currency system developing. Are governments and central banks across the world, are they comfortable with private currency vis-a-vis a fiat currency, a currency issued by a central bank on behalf of the sovereign? I think these are the four fundamental issues which need to be first understood before we talk of any kind of regulation. And this is something which is very well recognized by the IMF FSB synthesis paper. The G20 summit, the leadership of the G20 has welcomed the IMF the IMF FSB synthesis paper. They have welcomed it because it's a good beginning to understand what are the risks and possibly how to deal with it. How to deal with it. I'm not using the word regulation. I'm using the word how to deal with it. Deal and regulate, I mean, I would like to use it in an interchangeable manner. How to deal with this. So in that way, I think it's a good beginning which has been made, and the understanding should become deeper, and there should be the whole issue has to be very, very carefully addressed. We are not trying to stifle innovation. Innovation which is in public good, which is in the interest of overall public interest, all innovations must be supported and promoted. So we are not against innovation, but innovation should serve a public purpose. Thank you.
Thank you. Thank you, Governor. I mean, you are extremely emphatic that you will not nudge from your stance. Great to hear that. And I'm sure you will convince when your forum with other central banks. Sir, there's a tea or coffee you can, if you wish to have a thing or not. So another thing, I think everybody...
I don't want to take a drinks break and give Tamal more time to come with a bouncer or a googly. So.
Sir, your focus and rightly so, for the past 6 months on corporate governance in banks. You have called the bankers, you have called their boards, and you had multiple meetings, and repeatedly you have been focusing on that. That's the one side of the story. I don't think anybody would find fault with Reserve Bank of India on that. But we do see, like we who are outsider, there are certain problems with certain banks. But you don't talk about that. Unless this is an extreme case where you put your CGM as a board member there, etc. But otherwise you don't do this. Is it because you always talk about that our macroeconomic stability is immaculate, etc., etc., so you feel like you should not talk about that? Because market knows, and stock market accordingly reward or punish the banks, that everything is in public domain. So is there any, sir, can you just explain to us your approach to governance? There are certain, I will not call them rogue, but there are few banks which are ill-governed. Market knows about it, everybody else knows about it. You also know in your corridor there are talks, but you don't talk about it. Is it because you spoke always talking about financial sector stability is immaculate?
The headline is that the Indian banking sector and the NBFCs, the Indian banking sector and the non-banking finance company, the banking and the NBFC sectors at the moment are healthy and robust. You look at the aggregate level, or you look at individual entity level. Banks, you have the data for all the public sector and private sector banks. We have seen the data. Even NBFCs also, if you look at the top 20 or top 25, which would broadly represent 75 or 80% of the asset size of the NBFC sector, their financials are robust and healthy at the aggregate level as well as at the individual entity level. Now, governance is something beyond these numbers. These numbers ultimately in the long run flow out of good governance. So our emphasis has been on good governance to ensure that these financial norms, these financial parameters which the banks and NBFCs have achieved over the last few years, thanks to number of measures taken by the banks and the NBFCs themselves and by the by the Reserve Bank, and also several steps by the government, Government of India with regard to public sector banks. Because of a mix of all these factors, the banks are today very robust and they are reporting very good numbers. We want these numbers to continue, and we want, number one, these numbers to continue and improve further. Number two, we want that underlying these numbers, certain basic deficiencies should not get camouflaged. And our analysis shows that what differentiates a good institution, a banking or a non-banking finance company institution from a not so good one, is the governance. And in governance, we are highlighting broadly three components. I have talked about it on several occasions. Risk, that is, strong, robust risk management, compliance culture, including ethics, and the strength of internal audit. These are the 3 points which we have been highlighting. So wherever we see deficiencies at any particular entity, now let me again reiterate that at the systemic level as well as at the entity level, our banks and large NBFCs are very robust. But wherever we see any deficiencies or any deviations or some problem building up somewhere, our job is to immediately, flag the issue with the entity. We don't want to hit big headlines by, making statements that such and such bank has a problem, because sometimes in public mind, in public perception, the interpretation may be disproportionately high or excessively high compared to the actual nature of a governance deficiency. When we take some action, internally, when we take it up with the bank, we know exactly what is that deficiency, we quantify that deficiency, we define that deficiency, and we want the particular bank or NBFC to take necessary corrective measures, which they do. But the moment we start if we want to hit headlines, you will unnecessarily be creating a kind of a crisis of confidence in that particular bank or NBFCs, which will be completely disproportionate to the nature of the internal deficiency. So therefore, we have been, wherever we find deficiencies, our supervision teams are, our supervisory teams are in direct touch with the management of the banks, and it is taken up. I will not mention entities, but let me mention a few examples. Like the IT system. We are now doing our, our seaside team does, they have been now doing a thorough verification, inspection of the quality of the IT system in banks and what kind of cybersecurity facilities they have, what kind of IT systems they have. Wherever we have deficiencies, we have immediately flagged the banks to the management of the banks, and our supervisors have then sat down with the banks, and we have insisted that please give us a timeline by which you will, within which you will take necessary corrective measures. So we are playing, when we emphasize on governance, we don't want to create unnecessary panic, and there is no reason for panic when there, we don't want to create that kind of a panic. Second, we want to play a constructive role to work with the management of the bank in a manner that the real genuine problems are addressed and addressed effectively, and ultimately it is the quality of governance in a bank or an NBFC which will ensure that the bank continues to be there. You mentioned at the beginning that RBI, that we are at the top and all that. I don't know whether at the top, but we are somewhere there. Now, it's easier to reach there, but it's far more challenging to be there. And this I am not saying for RBI, this I am talking about our financial sector and our financial institutions. So as a regulator and supervisor, we are basically, our approach is this, what I have just mentioned.
Thank you, Governor. So you are doing your job, you know what is there, but silently you don't want to create any noise. Right. Sir, if you don't take any offense, I just want to understand one thing. Governance, you are very concerned about, but you are also looking at the business model. I'm just academic question, again, don't take any offense. Is it a regulator's job to teach bankers how banking, what should be my business model? Now, the bankers are there, they will never ask you, but they, in private, they whisper into my ears, ask governor this kind of questions.
They know it, they know it very well, and I doubt whether anybody would have whispered it, but, but even if they have, and since I am addressing a bigger audience and a wider audience, which perhaps is watching in the in the YouTube and your YouTube through the YouTube facility, let me say that when we say business model, we are not referring to micro level business models. Why a particular loan is given like this to a particular entity, or why a class of loans, this is the interest rate charge. We are not looking at that. When we say business model, it is from the point of view of the structure and composition, or rather say the structure of the balance sheet of a bank. What kind of risk appetite the bank is providing for, or the bank balance sheet reflects. What is the risk appetite that it reflects, which the bank is, taking? What is the risk appetite in that bank? Whether that risk appetite is matched or backed by adequate risk mitigation measures. So we are looking at more structural issues in the balance sheets. We are also looking at the revenue models of the banks. Short-term risks, short-term gain versus long-term risks. We are looking at issues which every banker does, the asset liability balancing, whether they are appropriately managed, whether they are appropriately balanced, the asset and the liability. So therefore, we are looking at the balance sheet of the banks. When we say we are looking at the business model, we are looking at the business model of the bank as reflected in its balance sheet, or as it would feed into the balance sheet, is more from the point of view of the structure and the strength of their balance sheet. I have said it earlier that a problem which looks small in some corner of the balance sheet of any financial service provider, bank or non-bank finance company. A small risk which initially appears small in some corner of the balance sheet can become highly risky unless it has been properly understood, unless it has been properly mitigated. So our emphasis is more on that. The second aspect I want to say is that, to supplement what I have said, we have now for last several years, we have adopted risk-based supervision. When you are doing risk-based supervision, you have to look at what are the risks which the banks are taking, what are the risks and what are, whether it has been properly addressed by the bank in its balance sheet. So I have said it earlier, but I am just putting things properly. And the recent developments in the advanced, particularly in the United States, some bank failure, and also in Switzerland, the large bank failure there. I think once again, the central banks and the banking sector regulators and supervisors have woken up to the fact that they need to do much more intensive supervision. There is growing realization that many countries, the banking sector supervisors in several countries, let me say, not say many, but in many countries or several whatever, the supervision had somewhat fallen behind the curve. I can say with confidence that our supervision has by no means fallen behind the curve. It has remained in sync with the requirement of the growing complexities of the financial sector, the banking sector world over. So in US, perhaps I'm not commenting on US generally, but I think you will now see more and more, or perhaps we are now even now seeing more and more banking sector supervisors where central banks are the supervisors, they are doing it, and in certain countries where there are other dedicated supervisors, they are doing it. They have started looking at the business models of the banks. The failure of the particular bank in the United States had a lot to do with the business model. Yes, I would first say that it is a failure of the bank which goes down that path, because the bank management is the first line of defense. Central bank is not supposed to do risk management. Risk management has to be done by the management of the bank first and foremost. Central bank, as the regulator and supervisor, is supposed to keep an oversight and point out where we feel there is deficiency. So therefore, when we say that looking at business model, I would like to sort of submit for your consideration and consideration of everybody that we are not looking at the commercial aspects of their business models. We are looking at the overall risk matrix, the risk appetite and the risk mitigation and the structure of their balance sheet. That was a long answer, but
Thank
sorry,
you,
I thought
I think all of us agree, and all of us, we discussed that this is the new RBI. I mean, we may call you in some sense very aggressive, but the supervision and inspection of Reserve Bank of India in the recent time, and you are much more, things are, you are much more aware and you are much more proactive. This is a new RBI. Bankers do admit that. So it's wonderful, and that's, I'm sure, the world recognition only because of that, not for apart from other things on the macro, whatever you have done. Sir, one more question which is little irritating. After that, we'll go back to macro. Is this, there's a huge challenge before the banks to attract talent and retain talent. And on the way, it comes something that they say in private, is this the compensation structure? Because you are not liberal at all. We know what happened in 2008 in US and subsequently the global thing and all. But you get into this, if you want to pay more than 20 lakh bonus, you cannot pay that at one go, you have to do this. So these little things, is it possible for RBI to be little liberal on that, you think? Because they think that for attracting talent, RBI is keeping an eye on the salary and parks, etc. comes on the way.
No, you said that they are asking the banks. I don't know why they are not asking me directly. In fact, they do. In fact, they do. Not in a meeting, but one-on-one, I do meet the bank CEOs. One-on-one, I meet anyone who wants to meet them, you can do a secret ballot and find out. They don't have to reveal it. But I do meet them one-on-one. And whatever are their concerns or their points, they always share with me one-on-one. And they do that with the deputy governors or, also of the Reserve Bank. So there is that interaction which is going on. Now coming to this specific question of attrition and the compensation package, etc. Now public sector banks, it is with the government under the law, so we don't deal with that. Private sector bank, only the whole-time directors, that is the CEO and other whole-time directors, only their compensation package comes to Reserve Bank for approval. And you know it, everybody knows it. It is ultimately the NRC, that is the nomination and remuneration committee, the NRC of the bank boards and the boards of private sector banks, which are expected to decide the compensation package of the banking executives. Top to bottom, including the whole-time directors and the CEO. So when they send it, I would say that in almost all cases, excepting a few, where we find that the increase in package is not commensurate with the business growth of the bank. On the contrary, if the bank has reported a negative, compared to the previous year, if the bank performance is going down, you cannot have a situation of excessive increase in the compensation package. So very few cases where we such things, we put some restrictions. Most of the cases we return it to them, saying that please relook and come back to us. So therefore, we don't put any restriction on that. Second, and the most important thing is that, first is that the boards of the banks, they fix it and we don't unnecessarily interfere. Second thing is what we have done in our circular on compensation for the private sector banks, it's a principle-based regulation. We have said that the fixed pay and the variable pay, the ratio will be so much. Beyond that, we have not said how much should be the fixed pay, how much should be the variable pay. We have only said that you maintain this ratio. Beyond that, it's a principle-based regulation which we have done. And the Banking Regulation Act expects us to do it. In fact, it mandates that Reserve Bank should approve these compensation packages and ensure that they have used the word, the Act uses the, the term used in the Act is excessive. It should not be excessive and it should be commensurate with the, the size, the growth and the result, performance, etc. of the banks. So we don't like to, we don't do that. And talking about attrition, I'm just, adding one more point, which although you did not ask, we are also looking as a part of our supervision, the rate of attrition, which is seen to be high in certain private sector banks. And we have asked them to look at it because they have to really see, because every bank also at the end of the day, has to build up its core team, which should really grow with the bank over the years. But the thinking of today's youngsters has changed. Earlier, if you ask any of the senior bankers how many banks or how many institutions they would have worked in the, let's say, last 20 or 30 years, they would maximum say 2 or 3 institutions. I worked in this bank, then this bank, then now I'm here in this institution for last 10 years or 15 years, like that. But it's not so with today's youngsters. Today's youngsters are thinking differently. With so many opportunities, especially coming up from the fintech sector, from NBFC sector, the youngster, this is a very impatient generation. Nothing wrong with it. Nothing wrong with it. But I think it's for each bank to build up its own, own core team. Because there has to be something called the organizational culture. Like, I have come across many executives who proudly say that, I worked in that particular bank for 15 years or 20 years. Now, that is something which will add to their, the credentials and to the CV. So, I just took it aside and we are now looking at this. RBI has always looked at the attrition rate in various banks. Now we are looking at it very closely because we find that the times have changed and banks also need to give greater focus on this rate of attrition. It's for the banks to really analyze and deal with it. The counter view, in fact, somebody pointed out to me is that so be it. If the attrition is high, let there be a churning. Why should you bother? So therefore, there also we have not prescribed any norms or standards. We have just left it to the bank managements. We feel your attrition rate is high. It's for you to do whatever you want to do, because ultimately it will tell upon your organizational, culture, your the building up a core team over a period of time.
Thank you, Governor. So though if you are enjoying this candid conversation, give him a big hand. And time flies. Time flies, sir. We have met 40 minutes and still I have a few things left. We can continue a little bit, sir, with your permission. And those bankers who have told me to ask these questions, I will not name anybody. I have asked on your behalf. Governor answered. If you are here, you have heard him. So that's it. Beyond that, I don't want to say anything. Sir, the new investment norms that you recently circulated among the banks, that the full and final. I'm not getting into the nitty-gritty, but from April 2024, you have said that banks can have the entire government bond portfolio in HTM category. Now, this I believe, and I mean, it's the fact that it's in international standard, it's in sync with international standard. But Reserve Bank of India's approach was actually very different. You have been raising it and coming it down, like it was 18%, then you pushed it up. From 25%, it was brought down to 19.5%. Then during COVID time, you brought it up to 23%. And now the plan had to be bring it down to in phases. Instead of bringing it down, you have said no, as much as possible you can keep it under HTM, which means 100% of my bond portfolio can be in HTM. Now, I have a sneaky feeling that will it prompt lazy banking? If I am a banker, why should I try to get auto loan and home loans, etc.? If I am getting good money in the government bonds, I'll just sit on it for 10 years, 20 years, 30 years. I don't need to do anything.
No, on the contrary, you said lazy banking. On the contrary, it will lead to, I feel, active banking. I'll tell why. Today, about two-thirds, if I remember correctly, about 70% of the investments made by the banks, 70% of all their investments are held in HTM category, and it is coming down as the banks have to give more and sanction more and more loans. So 70% is in HTM category, and the rest, 70% of the investments. So obviously it's putting some kind of pressure on the lendable resources available to the banks. And the SLR holding of the banks for the last several years has been well above the SLR minimum requirement. Now in the recent months, as credit offtake has picked up, the banks are slowly reducing their SLR levels. Wherever they had excess SLR, they are reducing it. Now from the point of view of stability or safety or security of a bank, we already have, it's by way of a side point I'm mentioning, we already have the LCR, that is the liquidity coverage ratio, 30 days liquidity. In a stressed situation, the banks are supposed to keep. There is a LCR requirement which the banks are adhering to. We also have in parallel the, what you call the SLR, the SLR requirement, which they are all required to maintain and they are maintaining. We also have the CRR requirement, cash reserve ratio, which the banks maintain. So from the point of view of safety and stability of the, safety of the bank, these are already requirements. Now HTM, you said that, why have we removed the cap? So even if we remove the cap, it's not going to become zero. There will be still HTM because you have SLR, and these have to be high quality. these have to be, what we call HQLA, high quality and liquid assets. For SLR, LCR, and for, CRR, of course, it is cash. Now, so therefore, what is now happening is that as things stand today, the HTM holding of the HTM holding of the banks, that is held to maturity of the banks, the fair value is not determined and is not disseminated. When SVB happened, if you recall our last financial stability report, if I remember correctly, in the last financial stability report which we published in June, there we have given the data, we have done a valuation of, we have done the mark-to-market exercise, valuation of the HTM holding of the banks, and we have shown exactly that even if you do that valuation, still the banking, the balance sheet of the banks are continuing to be quite healthy. And now we have mandated, it's a requirement, that the HTM holding, the banks will have to do their own internal risk management, interest rate risk management they have to do. They have to also, risk management they have to do. They have to also do the mark-to-market valuations, fair market value they have to arrive at. Mark-to-market valuations they have to do, and they have to give it out. They have to, that means it will come as a part of their balance sheet or in their quarterly, audited results. The auditor would be required to say that the HTM portfolio of the bank, based on mark to market, this is the plus or this is the minus, this is the appreciation or this is the depreciation. If there is a haircut, how much has been the haircut? So we have made the system more transparent. So I would therefore like to summarize and say that it will not lead to lazy banking. I think we are moving along with the international pattern, international norms, and if anything, it brings in greater transparency to the HTM portfolio of the banks, because the mark-to-market valuations will have to be now done and will have to be published. And internally the banks will have to do their own interest rate risk management.
And this disclosure also rules out any possibility of having a Silicon Valley bank here, right? Absolutely right. So, so one question is on the NBFC segment. Now you have shifted to, not now, for quite some time, the rule-based regulation to NBFCs. And you have identified the upper class, the top-end NBFCs, which are treated almost on a par with the banks, including the liquidity, LCR requirement and all. So, I mean, if I am running an NBFC and I have a large NBFC, what would be your advice? I mean, is actually as an RBI, I can clearly feel as an outside observer that you want to kill the arbitrage opportunities which are existing. But now is it the RBI's way of persuading the large NBFCs that better to become a bank? Because I am not being allowed to take public deposits the way the banks are taking, but you are subjecting me to everything. I mean, not SLR, CRR, but even LCR, NPA norms, SMA1, SMA2, everything that what is bank subjected to. Whereas my cost of fund is far higher than banks.
No, upper layer, the norms are, the norms are obviously stricter than the middle layer, etc. That is because of the size and complexity. And we have explained why we have gone for this, why we have gone for this scale-based regulation, because of the size and complexity of the large NBFCs. Some of the NBFCs have balance sheet size which is much larger than mid-size scheduled commercial bank. So therefore, in the interest of overall financial stability, this was something which had to be done, and we have done it. Now, the entry, you said that they are almost similar, but it's not so. I mean, there are fundamental differences. The entry limit, for example, in bank, a new applicant will have to provide 1,000 crores, 1,000 crore of equity capital he has to bring in. It is equity capital he has to bring in 1,000 crores. Whereas for an NBFC, for a registration, it is still 10 crores. and you may become an upper layer. So it is still 10 crores. Then you have other requirements like CRR, etc., which is a big difference between the NBFCs and the banks. The CRR of 4.5%, NBFCs have no such requirement. So there are lots of differences, and the whole NBFC sector also enjoys a certain flexibility with regard to lending. Now, for example, in the case of banks, the banks are expected to have board approved policy for sectoral caps, how much exposure, credit exposure they should take to which particular sector. There are board approved policies, and that is mandated, that is a requirement mandated by the Reserve Bank. Whereas for the NBFCs, we have not done it. But it is different that many many sort of, what do you call these, the larger NBFCs, they're doing it themselves by way of prudent management. They are doing it. So therefore, there are fundamental differences between NBFCs and the banks. NBFCs enjoy greater flexibility. We have also enabled co-lending now between the banks and the NBFCs. For priority sector, we have also enabled the banks to provide to do lending through the NBFCs. That window has been given. Of course, there is some narrative being built up that the bank lending to the NBFCs are going up and it can be a risk factor, etc. That narrative is coming, but let me say very clearly in this BFSI event that all these numbers, banks' exposure to NBFCs at the system level as well as at the individual banks level, all these aspects and far more granular details with regard to, are monitored by the Reserve Bank regularly and much more intensively than anyone can imagine. All these numbers are very carefully monitored, and upper layer NBFCs, I mean, anyone is, as you know, it's on, their licenses are on tap, and we are not really, it will not be correct to say that we are nudging them to come as banks or something like that. We are not doing that, but it's always open to any, upper layer NBFC or anyone for that matter to apply for a banking license because it is on tap. Anybody can apply at any point of time. Then of course it has to satisfy our fit and proper guidelines and other requirements.
Thank you, Governor. You can't be more explicit than in this. I will not ask you about inflation and interest rate cycle, etc. We discussed it thoroughly yesterday's economist panel. There are 6 of the best economists of India presented here. So there are questions from the audience when the rate cycle will change. I will not ask you because you will not give the answer. So I'm not going to ask you. You have been repeatedly says that your focus, and you spoke about Arjuna's way of looking at things, is 4% inflation on a durable basis, not 6%. So it's a great commitment one can have from Reserve Bank of India Governor, because at some point of time there are discussion, we shifted it from 4% to 6%, but you made it very explicit, whatever needs to be done, you are stuck to 4%, and everything else what you have done is aiming in that. But my, sir, very simple question is this. There are a lot of uncertainties, the geopolitics, the 2 regions, I'm not repeating everything else, the spread between Indian papers and US papers shrinking by the day. You spoke about Waymo through auction. You have done some screen-based Waymos in the recent past. Our currency is doing pretty well compared to most other currencies, but if the way the FDI outflow, if it continues, there could be pressure on currency. All these things put together, I mean, can you have an independent monetary policy? Is India decoupled, or there could be situation like that, you need to change, you need to take a different approach?
Now,
decoupled.
Yeah, so I'll come to the question, but before that, just a few facts I would like to place. There have been, from the equity segment, there have been outflows. I mean, FPIs have, there have been equity related outflows. But all the outflow that has happened over the last, particularly last 2 months, before that we had heavy inflow in, now we are in almost November. So July and August we saw very, there were very strong inflows into, into the Indian market. FPI inflows were there. It was only in the in September and October that there have been outflows. And there have been equity-related outflows also. But I want to set the record straight. The outflows are not entirely because of equity-related. In fact, the equity-related as a percentage of the total outflow is much less. Outflows are mainly related to import-related import payments, payments for imports. It has been repayment of earlier ECB loans. So there are several other components. It's not as if the entire outflow is because of FPI outflow. So that is one record I want to, put it straight. Now, our monetary policy, you mentioned about the difference in the bond yields and all that between us and the advanced country, United States you are referring to. Now, we look at the international factors. We look at all possible international factors because we are living in a globalized world. We will be impacted by what's happening all around. But ultimately and eventually, our monetary policy is primarily determined by domestic factors. By domestic factors, I mean what is the inflation growth outlook that we have. What is our anticipation with regard to inflation trajectory, with regard to growth trajectory as provided in the RBI Act. So the inflation growth dynamics, its future outlook is something, in other words, it's the domestic factors which primarily are the principal determinants of our monetary policy. Our monetary policy is not influenced by what is the differential in bond yields or if currency is depreciating. Many countries, many countries do interest rate hikes to manage the pressure on their currencies. Recently, I think Indonesia probably did it. There are other countries in our region who do it from time to time. Singapore has a monetary policy framework where they don't have inflation as a target. They have a band of exchange rate, a band for exchange rate as the principal target. So therefore, we look at international factors, we take them into consideration because we are living in a globalized world. We are impacted by all that is happening around us. But ultimately and eventually, our monetary policy is dependent on the growth inflation, the inflation growth. Otherwise, some of your friends may say, why governor said first growth and then inflation? So that means the RBI is changing priority. No, let me say that we look at the inflation growth dynamics. First priority is inflation at the moment. And based on that, we decide policy.
Thank you, Governor. I mean, we have never seen, there are not too many governors we have seen which can communicate so well, sir. We have almost finished our time, but with just two more questions. And your capability of convincing us is so strong. I must, with your permission, I must tell the audience one small anecdote. This happened a few years back, just before COVID. Sir just took over, I think, at that time. There was a book launch of Dr. Y.V. Reddy and another Reddy, I am forgetting his first name, jointly written. And Mr. Das, RBI Governor, I think you are just few months old in office. You came to launch the book at Y.V. Chavan. And after the launch, Dr. Reddy was talking about that there are various people, bureaucrats and governance and all. So there are bureaucrats and governance who will call you to your room and and say that I have whatever the proposal is, great proposal, and backslap you, and still you come out of the room not very happy. And there are governors who would say, I'm afraid I can't accept your proposal. But the way he would say that and the way you would explain why not explain, you come out of the room extremely happy and you will never bitch about the governor. And then he looked at, he did not name it, then he looked at and pointed finger to Das. Sir, you remember that? Yes. So that is the power of communication. We are just coming to almost end and all this. You have been repeatedly saying that India is the global growth engine. Just for academic, and we are a few months away from general elections, state elections are coming up. This is the geopolitics, this is the currency, this is the money outflow, inflow, whatever it is. So are there any concern at the academic level which can derail the growth engine?
You see, so far as growth is concerned, let me say that the growth momentum in India continues to be what it was. In other words, the growth momentum continues to be strong. The second quarter GDP number, which will come at the end of November, will surprise. We do expect, I expect that the second quarter GDP number, in all probability, I must qualify because ultimately the numbers, will tell when the numbers tell for themselves when the numbers are released. But looking at the momentum of economic activity, looking at a few early data points which have come in, a few early indicators, I can say that the second quarter GDP number, as and when it is released at the end of November, in all probability will surprise everyone on the upside. That is the, let me say that. We have, I think in RBI, we have said, just check it up, I think second quarter we have said 6.4 or something like that. So it can be
6.5 is the average.
6.5 is the annual. I think second quarter it is 6.4, but please check up. It's likely to surprise on the upside. So that is likely to happen. And with regard to the concerns, I think the biggest challenge to every country, not just India, is the evolving geopolitics and its fallout with regard to financial markets, its fallout with regard to global growth. New flashpoints are developing, new geopolitical conflict points are developing. So how the geopolitics internationally, geopolitical conflicts are going to play out, whether there are new flashpoints coming up. So whole geopolitics, I think today poses the biggest risk for growth, not just for India, I think for the world as a whole. For India, any geopolitical crisis, we saw it immediately after the Ukraine war. It immediately led to, financial market volatility. It also to some extent has, pulled down global growth. So therefore, it is the geopolitical uncertainty which I think is the biggest risk to global growth. But so far as India is concerned, even with all geopolitical risks, I can say with confidence that India is better placed compared to other countries to deal with such risky or such potentially risky situations. We are better placed.
Thank you, Governor. I mean, thank you for exuding the confidence, and we are all, we trust you and we feel very reassured because the way you handle COVID, your unique way of raising interest rate in quick succession, then staying put there, and your reaffirmation of inflation targeting at 4%, everything is so reassuring, and we are happy and fortunate to have you at the central bank in India. I'm just coming to that end. I would like you to what is your message? Because here there are bankers, there are non-bankers, there are insurance. Everybody is the miniature of Indian financial sector, 750, 800 odd people sitting here. And there are thousands of people on watching you. What would be your final message to them? If you want to say anything. And before that, just with your permission, one personal question. I mean, that people ask me, particularly the people from overseas who join you for discussion, etc. They ask me, they're very intrigued your passion for ties. They said, have you seen governor's ties? And they said that they try to gauge the enormity of the situation, etc. by color of your tie and the tie. Is that correct? Like if you are happy, you prefer one color. If you are not so happy, you are little this thing, you prefer another color. Your tie is a mystery. Your love for cricket, everybody knows. Tie, it's a sort of, they try to decipher that by looking at your color, whether you are going to for a rate hike or status quo, they want to gauge. So can you tell us a little bit about this, and then we'll
I think I would be curious to know what is the interpretation they derive from various colors of my tie. It's quite a, I'd be curious to know.
You have a great collection, right, sir?
But, I don't know. But let me say that I don't know if ever I would write a book of memoirs or something. I have never thought about it. I don't take notes or anything to keep it for writing a book. I have never thought about it. But if ever I decide to write a book, I think you have given me some clue that this could be one of the sub-chapters about the color of the tie. And perhaps perhaps I can give, after my tenure in RBI is over, perhaps I can give a lecture or a speech somewhere about monetary policy and the color of the tie. So, but talking about, you mentioned...
your message to the financial
A message, well...
anything, because you can see it's a miniature Indian financial system sitting here.
Message, I have been talking about it extensively again and again. I have talked about risk management. Even today I talked about governance. But since you are asking and since you are, I think, since we are in a World Cup season, let me just say the message is to all financial sector players and stakeholders, please play long term, play like Rahul Dravid.
Thank you. So I reworked my initial sentence where I said that he is the central bank of the world and he has got all the recognition this year, and this is kind of test match and he's the captain, and test match which was here. So he's not the captain, he's actually the coach. He's actually the coach. So with that note, I would request you to give a standing ovation to Mr. Das, RBI Governor, for an outstanding talk. You cannot be more candid and more forthcoming than this. Sir.